This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Bounce back, stocks rally and rally big as investors figure economic woes may push the European Central Bank into action that could help the market.
On track, Federal Reserve officials stick to their plan to potentially hike interest rates later this year. But is the market, not the Fed, the ultimate arbiter of when rates will rise?
Home sweet home. President Obama has a plan to bring more first-time home buyers into the housing market. Question is, will it work? All that and more tonight on Nightly Business Report for Wednesday, January 7th.
Good evening, everyone, and welcome. I'm Tyler Matheson. A bounce back on Wall Street today. The major averages saw their best one-day gains in 3 weeks or so. They got a big boost from an upbeat report on jobs, news that the trade deficit narrowed more than expected in November, and anticipation that the European Central Bank will move forcefully and soon to stimulate the region's economy. Then, too, the minutes from the Federal Reserve's latest policy meeting released today confirmed that interest rates won't move up soon or fast here. Put it all together, and stocks broke a 5-session losing streak despite news of a terror attack in Paris that left 12 dead. The Dow surged 212 points, the Nasdaq up 57, S&P added 23. Oil prices closed higher for the first time in 5 sessions. This after U.S. crude inventory showed a surprising drop last week, even though gasoline stockpiles jumped to record high levels. U.S. crude settled 72 cents higher. It finished at $48.65. Brent up a nickel at $51.15 a barrel. Now, across the pond, the European Union reported today that consumer prices fell 0.2% last month. That is the first drop in prices in 6 years, and it's raising worries about the threat of a Japanese-style deflation. So what could that mean for the European Central Bank? Seema Modi takes a look.
Eurozone inflation turned negative in December, meaning that prices are going down for the first time since the depth of the financial crisis in 2009. That's called deflation, and it can be a big problem for any economy. When prices are falling, consumers put off purchases, thinking whatever they want will get cheaper if they wait. That makes the economy shrink, which could lead to more deflation. You get the picture. Think about Japan's lost decade in the 1990s, a period in which it endured stagnant growth and high unemployment. Keep in mind, it still hasn't fully recovered. The pressure is now on Mario Draghi, European Central Bank president, to try to revive the Eurozone economy. Analysts were expecting Draghi to unveil full-blown quantitative easing, a strategy that worked in stimulating the U.S. economy, sometime in March. But given today's negative read on inflation, some are expecting Draghi to unveil bond buying at the next Governing Council meeting on January 22nd. Despite what is likely going to be a slow and drawn-out recovery, there are some investors who are bullish on Europe.
We have a positive view on Europe. We think it's consensus to dislike Europe at this point, and that gives us a lot of comfort. It's also a relatively cheap market.
And another factor that could help European corporations, a weaker euro, the currency trading at a multi-year low against the U.S. dollar. That's expected to provide a boost to exports and help earnings. In fact, Morgan Stanley forecasting a 10% rise in profitability in 2015, much of that having to do with the weaker currency. The wild card in all of this is oil, and while it may help some European countries that import the commodity, analysts say if prices continue to fall, that could push inflation even lower and make Mario Draghi's job to take Europe out of this downturn even more challenging. For Nightly Business Report, I'm Seema Modi in London.
Well, worries about Europe's economy and the sharp drop in oil prices over the past 6 months weighing heavily on Federal Reserve policymakers. But officials are still upbeat about the U.S. economy. Steve Leisman has more.
Minutes of the Fed's December meeting released today show central bankers focused on issues like overseas weakness and the decline in oil prices. But they largely believe the U.S. economic recovery can withstand those challenges. Fed officials mostly saw the decline in oil prices as a positive, thinking it will boost consumer spending, although they expressed concern about the impact it would have on capital spending as oil producers pull back. And the Fed saw it as a risk to their 2% inflation goal. But overall, many on the Fed said momentum in the job market and strong economic data suggests growth could end up being better than they forecast.
Looking at the bigger picture, we're still in a situation where the macro context has the United States, in particular, at above-trend growth and essentially zero interest rates. And the expectation that interest rates will stay low for a very, very long time, even as growth continues to cycle higher.
The Fed raised the possibility it could hike interest rates, even though the current core inflation rate, which excludes the volatile food and energy, is running at only 1.4%, below its 2% goal, as long as the Fed sees movement towards that goal. The Fed sees those rate hikes, though, at least a couple meetings away, and when it does start raising them, the Fed is saying hikes will be only gradual.
I still think the Fed is going to continue on the path of trying to push rates back up so that they can have some dry powder for the next time we get into the soup economically.
Markets turned their attention quickly towards the Friday jobs report, where Wall Street forecasts 240,000 jobs created in December. That would be the 11th month in a row above the 200,000 mark. The unemployment rate forecast to fall a tenth to 5.7%. But another plus 300,000 jobs report like last month or a quicker decline in the unemployment rate could change that Fed calculus and have markets believing in earlier rate hikes. For Nightly Business Report, I'm Steve Leisman.
Stephen Wood joins us now to talk more about the Fed, interest rates, and the markets. He's the chief market strategist for Russell Investments. Stephen, welcome. We just saw Lloyd Blankfein, the head of Goldman Sachs, and he had a comment today. He was asked about how much control over interest rates the Fed really has. Let's listen in, and then I want to get your response.
At some point, it doesn't become the Fed's decision, it becomes the market's decision. Once the Fed starts to move, they may want to go in a measured, slow pace. But if I'm sitting there in the market and I know they're going at a measured, slow, but inevitable pace, I'm going to get there in 5 seconds. The market may get there way ahead of the Fed.
What do you think of that?
I think he's spot on.
And what does it mean for me?
What it means for you. The Fed sets that overnight rate, and they set the shortest interest rate there is, and then the market sets all the rest of the interest rates. So the Fed can they can talk about things, they can try to give guidance, give the market information on what they're likely to see coming from the Fed, but ultimately the market is going to set the interest rates and what people think about what the Fed's doing. All that's very important.
So where do you think rates are going then? Where do you think the market is going to take them?
Well, I think first off, the Federal Reserve is going to do what they said they're going to do. Janet Yellen and the Fed will probably raise about the third quarter. They'll go from a zero rate to something maybe a half a point, maybe a quarter of a point in there, more of a symbol that we're no longer in these emergency room measures that we've been going through for years, that we kind of discharge the patient from the emergency room. And then interest rates out, maybe 5-10 years is probably going to tick up. We would think maybe in the 2.75% range by the end of next year, maybe 3% on the 10-year, because the economy in the U.S. is improving. Labor market's improving, financial markets are improving. So when some of this oil volatility works its way through, the Fed's going to see that the markets are doing
Is
really
the U.S. economy, Stephen, strong enough to pull the rest of the world, which it sure seems like it's doing to some degree right now, particularly Europe and China and Japan, or will those economies pull the U.S. economy back?
And that is one of the great questions for 2015. China, for example, is slowing down a lot.
Right.
And the United States this year could actually be growing faster than China, depending on how the data work out. I don't think the United States is big enough anymore to do what it could have done in the 70s or the 60s, because we're such a large percentage of the world, but it's going to be very important. So the United States, we think, is going to do very well. We think Europe's going to do better as the European Central Bank really starts printing a lot of money, does their own quantitative easing. So I think that the global growth is going to be a challenge, but the United States is going to go back to what it was maybe 20 years ago, when the United States was a strong engine and the rest of the world was trying to catch up. It's been a while, but I think we're going back to those solid days.
So if you had to prioritize where you would put money to work right now, the U.S. sounds like it would be on the top, and it sounds as though you'd follow maybe with Europe over other.
That's exactly right. So we like the United States, the fundamentals are good, but our market's gotten expensive. So we're stock picking. It's a multi-asset strategy too, in equities as well as fixed real assets. But from a valuation perspective, we look at Europe. Europe is a lot cheaper than the U.S., and the fundamentals don't look nearly as good. But if the economy surprises to the upside and does better than most people think, equity markets should respond in Europe. And if the economy doesn't surprise the upside, then the European Central Bank is going to have to print a lot of money, which markets
Quick thought here, the Fed minutes were out today. Number one, was there anything in them quickly that stood out to you? And number two, are they as important as they used to be? Because, by golly, we had a 90-minute press conference the last time
good point.
the Fed announced its decision.
I think so. Nothing was surprising, down center pinned. The Fed is on that policy path. I don't think they're going to go off of it. And I think the Federal Reserve is very, very important. This is a central banker's world, and we're just kind of playing in it right now. European Central Bank, Bank of Japan, the Federal Reserve, still very important players.
Stephen, thank you. Great to have you with us. Stephen Wood, Russell Investments.
Well, Stephen just mentioned the economy, so now to the economy and the good news in the labor market. Payroll firm ADP reports 241,000 private sector jobs were added in December, more than economists expected, and an encouraging sign ahead of Friday's December jobs report. There was also some good news about November's federal trade deficit. It shrank, falling to the lowest level in about a year, mostly because the U.S. imported far less oil from overseas.
On to housing now. Mixed bag of data about mortgage applications over the holidays. Mortgage Bankers Association reports that apps for new loans shot up 11% last week as interest rates edged lower. But that comes after an 18% decline during the Christmas week. That's usually a slow time, of course, for home sales.
And the holidays, of course, are over, but it's still January, and that is the slowest season for the housing market. But potential home buyers are about to get a much-needed boost from the federal government. Diana Olick explains.
President Obama heads back to Phoenix tomorrow, the hard-hit market a favorite backdrop for him to announce new help for housing, as he did 2 years ago.
Now that we've made it harder for reckless buyers to buy homes that they can't afford, let's make it a little bit easier for qualified buyers to buy the homes that they can afford.
This time, the president will announce a drop in the annual insurance premium at the FHA, the government's insurer of low down payment loans, from the current 1.35% of the loan to 0.85%. That will provide the average FHA borrower a savings of about $80 a month on a $195,000 loan, according to CoreLogic. This action will help millions of families save billions of dollars in mortgage payments in the coming years, the president said in a statement previewing the details.
This is a matter of getting the pendulum back to a balance point where you're not over-promoting homeownership, but you're not barricading the doors needlessly by overcharging home buyers who could come into the market.
FHA was bleeding cash during the housing crash and required a taxpayer infusion. In order to shore up its reserves, it more than doubled its premiums, leaving much-needed first-time buyers out in the cold. FHA's insurance fund recently moved back in the black. The change will help borrowers, but it could also help the FHA itself. Fannie Mae and Freddie Mac recently announced their own new low down payment loans, which would be cheaper for high credit-worthy borrowers. Borrowers the FHA cannot afford to lose.
This is great for the FHA. They've been losing market share to Fannie and Freddie. This allows them to solidify their position in the market, to rebuild their finances, and it opens the door for a lot more people to enter the housing market.
The president will also address new efforts to assure FHA lenders of when they will and will not be held responsible for loans that default. For Nightly Business Report, I'm Diana Olick in Washington.
Well, that news about a half-point reduction in FHA mortgage insurance premiums was good news for shares of home builders today, but not for those insurers. Shares of builders like KB Homes, Pulte, Lennar, D.R. Horton, each up about 5%. Beazer also seeing solid gains, as you see there. But shares of loan insurers like Essent Group, Radian Group, and MGIC all came in with rather substantial losses.
Well, still ahead, shares of Alkermes rise sharply on a promising treatment for schizophrenia. That's an area of the market that has been really tough for drug makers. Some action today in the newly Republican-controlled Congress. The House overwhelmingly approved a bill today that would extend the Terrorism Risk Insurance Act until the year 2020. The program expired on December 31st, but a new bill has been tweaked a bit to change part of the 2010 Dodd-Frank Act. It would prohibit federal regulators from imposing margin requirements on non-financial users of derivatives. After failing in the old Senate, the updated legislation is expected to pass in the new Senate soon.
Blowout day for shares of the biopharmaceutical company Alkermes. Shares up 9.5% to a new 52-week high following encouraging news about breakthrough medications for illnesses affecting the central nervous system. Our Meg Terrell has the story.
Some good news this week in a market that needed it. Drug maker Alkermes reported positive results in 2 studies of drugs for depression and schizophrenia. It's been a tough area for the drug industry. The market for medicines for central nervous system, or CNS disorders, is one of the few in the industry expected to shrink over the next few years.
It's been difficult for new drug development for large pharma, certainly in the last 10 years or so.
That's not because those disorders are going away. About 26% of Americans have a diagnosable mental disorder, according to research from Cowen. The market for CNS drugs was $33 billion in 2013. Yet even as more mental illness is diagnosed, that market is expected to shrink to $21 billion in 2019. Patent expirations are cutting sales of many top drugs like Eli Lilly's Zyprexa and Cymbalta and Forest Labs' Lexapro. But drug makers have also backed away from CNS disorders in recent years, as development proved more difficult than other areas. According to the Tufts Center for the Study of Drug Development, medicines for CNS diseases take more than a year longer to develop and are less than half as likely to be approved as drugs for other diseases. Why? The disorders are complex and still not well understood, and improvement can be hard to measure.
For example, in cancer, if you run a clinical trial, you can use imaging equipment, X-rays or MRI, and look at the size of the tumor and objectively see whether it's growing or shrinking. In psychiatry, the endpoint, the questions we're asking patients to determine whether drugs work or not, are questions about how they feel.
Alkermes' stock soared today as it said it aims to start a late-stage trial of its schizophrenia drug this year. The medicine helped limit the weight gain associated with many therapies for the disorder, a side effect that can lead patients to stop taking the drugs. Yesterday, positive data on a late-stage medicine for depression also buoyed Alkermes' shares. For Nightly Business Report, I'm Meg Terrell.
A weak forecast sent shares of Eli Lilly down in today's session, and that's where we begin tonight's market focus. The drug maker has struggled recently because of competition from generics, and now it's expecting 2015 earnings and revenue to be shy of Wall Street's estimates. Still, the company is betting on a new pipeline of treatments for illnesses like diabetes and cancer. The shares fell slightly to $69.23. Monsanto saw its earnings fall by more than 30% in its first quarter, but the decline was less steep than expected. The company blamed lower corn seed sales in South America for its slump, but it still managed to beat on the top and bottom lines. That sent shares 1% higher to $117.21. And SuperValu also reported better than expected results for its third quarter. Its profits more than doubled as the supermarket operator posted sales growth in all 3 of its business segments. Shares were flat, closing at $9.19.
Keurig Green Mountain inked a deal with Dr. Pepper Snapple to sell pods that make do-it-yourself soda. Keurig is expected to come out with a cold carbonated drink maker in the fall, and it already has Coca-Cola on board. Shares of Keurig popped 4.5% to 133.2 I should say. Dr. Pepper also up 1.5% to 72.52, excuse me. Sirius, the satellite radio service, said it would beat its own 2014 revenue forecast as it has added more subscribers than expected. Its sales forecast is slightly below the streets, but investors seemingly overlooked that. Shares up nearly 2% to $3.41. Shares of Dick's Sporting Goods spiked on a report that it is in early-stage talks with private equity firms about going private. Sources say there is no formal sales process, and the retailer could decide to go in another direction. The stock surged, nonetheless, almost 12% to $55.01. And after the bell, WD-40 reported earnings and revenues that missed estimates. The company, which makes household products, said sales in Europe were hurt by currency exchange rates. Shares plunged initially after the bell. Before the close, though, shares were about 3% higher. They finished at $85.48.
The United States government is shedding some new light today on the hack attack on Sony Pictures, saying it is, quote, confident that the North Korean government was responsible for that breach. Eamon Javers has more.
FBI Director James Comey told a cybersecurity conference at Fordham University that he's heard the skepticism from cyber experts about the U.S. government's assertion that North Korea was behind the devastating attack on Sony. But he says he has access to classified information they can't see that proves the North Koreans were involved.
There is not much in this life that I have high confidence about. I have very high confidence about this attribution.
He also released new information about just how the FBI knows Pyongyang was involved, saying the North Koreans got sloppy and failed to cover their cyber tracks.
Either because they forgot or they had a technical problem, they connected directly, and we could see them. And we could see that the IP addresses that were being used to post and to send the emails were coming from IPs that were exclusively used by the North Koreans. It was a mistake by them that we haven't told you about before.
Also at the conference was James Clapper, the Director of National Intelligence, who went to North Korea just 2 months ago to obtain the release of 2 American citizens held there. Clapper said he had dinner with General Kim Young-chul, a North Korean intelligence official, and the man who would have signed off on the Sony hack.
He just got kind of louder and louder, kept leaning towards me, pointing his finger at my chest and saying the U.S. and South Korean exercise was a provocation of war.
And Clapper issued a warning. The Sony hack may be just the beginning.
And this recent episode with Sony has shown that they can get recognition for their cyber capabilities. And that's why we have to push back. If they get global recognition at a low cost with no consequence, they will do it again and keep doing it again until we push back.
And that could be bad news for other American companies. For Nightly Business Report, I'm Eamon Javers in New York.
Coming up, 5 years of solid growth for American franchisees has meant more jobs on Main Street, but the hurdles are now developing. We'll tell you that story next.
Look for even more auto recalls in 2015. That's what the head of the National Highway Traffic Safety Administration says. And that's because after millions of recalls last year involving defective airbags, faulty ignition switches, and other problems, drivers and car owners are now much more aware of design flaws and safety issues with their cars.
People are also more alert to safety issues concerning their health, and that apparently is thanks to the Affordable Care Act's health insurance exchanges and to expanded Medicaid coverage. A new Gallup poll says the share of Americans without health insurance dipped below 13% at the end of last year, a steep drop from more than 17% the year before. Meantime, just today, the administration said that as of January 1, 6.6 million people have selected a health plan through the healthcare.gov marketplace.
And some good news about small business hiring. The National Federation of Independent Businesses says job creation at small companies picked up in December, with 15% of member firms currently planning to take on new workers.
And finally tonight, another area that is expected to see a lot of growth during the next year is franchising. Kate Rogers has more on the outlook for 15.
For the 5th year in a row, American franchisees are on a winning streak. 2015 is projected to be yet another year of solid growth for the franchising industry, despite regulatory hurdles owners and advocates say are hampering the model. The International Franchise Association, the largest global trade group for the industry, says the sector is set to grow by 5% this year. This means cash to be made and jobs created. More than 12,000 franchise locations in the U.S. will create more than 247,000 jobs. The industry will also see increased economic output in 2015 to the tune of $889 billion, according to Steve Caldiera, IFA president.
The sectors that are really growing, while franchising is growing as a whole, are the quick service restaurant industry. Casual dining industry is coming back a little bit, which is good news. The retail sector. So as you see higher consumer confidence, lower energy prices are certainly helping put extra dollars in the pockets of working Americans.
According to Franchise Direct, the top 5 franchise models in the U.S. are Subway, McDonald's, KFC, Burger King, and 7-Eleven. The IFA and its membership report government regulations are standing in the way, despite the IFA's sunny outlook. Both minimum wages, which have been hiked in 21 cities as of the new year, and the Affordable Care Act have franchise owners like Matthew Patinkin concerned about the industry's future. He comes from a family of retailers and owns 70 Auntie Anne's franchises. 20 years ago, Matthew started his first store, and he's experienced significant growth since then.
The challenges that are out there right now are a bit daunting. And it's not just the increase in the minimum wage, and it's not just the Affordable Care Act. It's also, Department of Labor rules on overtime or on sick pay, and it's increases in taxes, and it's legislation that impact how franchise operations are run.
The IFA says 85% of its membership believes these two issues will have or have had a negative impact on their businesses. Fast food franchises in particular have had a rough 2 years thanks to pushback from workers striking for $15 an hour. It remains to be seen if the industry can continue its growth in 2016 in light of these hurdles. For Nightly Business Report, I'm Kate Rogers.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody. We'll hope to see you right back here tomorrow night.